What's going on, everybody? Happy Monday and welcome to another edition of Weeds Weekly, where I, Kevin Weedmark, yours truly, just walks you down the path of all things as it pertains to real estate and the economy. We talk about the past week, we talk about the upcoming week, and we get some random thoughts. So what are we going to discuss? The first thing we're going to discuss is a hangover, right? We've all been to Vegas. We know what a hangover is, so we're going to talk about that very briefly. We're also going to talk about our Achilles heel. What is it? It's been riding us for all of 2024, and it's on steroids this week. The other two items I'm going to discuss that I think are a little bit random is numbers don't lie, right? We're going to dive into exactly what that means. And lastly, I'm going to cover don't believe the hype based on a conversation I had with an agent this past week. So let's go over what happened this past week. And I discussed it on Friday. The biggest thing at the beginning of the week, the market was going through a hangover. That presidential election debate was a debacle. I don't care who you are. If you're an American, to see that on center stage was just, it was something that we did not need to see. And unfortunately, what it did is it gave the market, the traders, a hangover all the way across the board, especially in the Treasuries Department. Because what did it do? It creates uncertainty. When we have uncertainty, us as consumers, we don't like to spend money. We become a little bit more, we should wait, apprehensive. Well, guess what? Traders do the same thing, but they hedge the other way, which push rates up. Fortunately for us, we also had last week Fed Chairman Powell speak, and he kind of put, some of that at ease. He gave a little bit better statement with regards to where things are headed. He's still seeing things moving in the right direction, which is great. The Fed is still apprehensive about a rate cut, which is understandable given that their rhetoric since the beginning of this year and towards the end of last year has been they need consecutive months of good data in order to make a move. And then lastly, that they still needed some more time, just time to evaluate, right? That's their biggest thing. And then on Friday, the big things that were coming out last week were non-farm payrolls. And what we saw last week was jobs are starting to fall in line. We're not seeing robust numbers as we were. As a matter of fact, that big number, 272,000 that was reported last month, that kind of spooked the market and pushed rates way up. Well, that was off by 20%, right? Wouldn't it be great to just be off in your estimate and your accuracy by 20% of something that's going to affect your bottom line that much? And it's no problem. That number got revised down. So therefore, obviously, based on the numbers that have been coming out for especially Q2, everything seems to be moving in the right directions. And let's be honest, part of the Fed's soft landing is that jobs don't fall off, right? Because that would lead to a recession, make no mistake about it. So if the Fed can cleverly keep jobs just in line where they are right now, I think they'd be very happy with way things turned out. And that is obviously one of the stools they look at as it pertains to doing a rate cut. So what do we have this week? Well, we have our Achilles heel, as I alluded to right off the start. The Achilles heel has been inflation, and we have a lot of inflation data coming at us this week, right? CPI, PPI. We also have Fed Chairman Powell testifying again for his semi-annual report in front of Congress. And the most intriguing thing I'm looking to get out of that is I think his rhetoric is going to be the same. I think there'll be some very pinpointed questions, but I'm most curious, I'm hoping somebody asks him, what are his projections for 2025 and 2026? Where does he actually see unemployment? Where does he see inflation? Where does he see consumer spending, which i.e. is GDP? Where does he see unemployment reaching out into the future? Look, I think the remainder of 2024, we can kind of paint the picture. We may see interest rates drop anywhere from 1/4 to 1/2 point, but I don't think we're going to get anything greater than that. And I don't even mean that the Fed funds rate needs to do that. Remember, the markets are forward thinking. I just think that in general, things are not going to move fast enough with this election cycle. It's going to keep people in quicksand for a little bit longer than anticipated. Even if the market were to take a turn and the Fed was to decrease interest rates, I think dealing with that, and as we can see, the show that's ongoing, so to speak, and that's the other thing I want to talk about for this coming week, is the elephant in the room. Look, the Democrat Party is going through a lot of change. It's obvious. It's all over the news. Is Biden going to lead the party? Is everyone going to oust him? Who could it be? The person that it is going to be chosen by delegates, not by actual voters. I mean, it's kind of chaos at the moment. And until that gets resolved and gets a very pinpoint, we're moving lockstep in this direction, and which allows traders and allows consumers to digest, we just have more uncertainty. So it's something that we definitely want to watch. But from a long-term perspective, which is what the market looks at, they're going to be very, very concerned with these inflationary numbers coming out. Because look, the bottom line is this: we basically have the 3 months that I think it's going to take the Fed to actually do something. So jobs now is coming back in line. If we can get inflation continuously stepping in line at forecast, or even slightly below, because next month they'll reduce that forecast number slightly, that'll give us the 3 months. That'll give us July, that'll give us August. Oh, and wait for it, they will know those inflationary numbers before their September policy meeting, i.e. there will be their 3 months that will be required, in my opinion, for them to strategically do something. However, the market's already priced in about a 75% chance based off the labor market. And I was saying we were already there probably about a month ago. So again, looking really good for that September rate cut. Now I'm looking past that. I'm looking in November. I'm looking in December. What can we expect? And that, I think, the next 3 months will paint that picture. So let's get into numbers don't lie. And what do I mean by that? You know, so often we can dive into a rabbit hole, right? You get on your phone or you start watching a show, and then you watch one, and then you watch again, and you watch another episode. Just like that, all of a sudden you are absolutely immersed in whatever topic that you started looking up. And one of the things that I see in real estate starting to peek its head out a little bit more is we're going to go through a housing crash. And I don't think that there could be anything further from the truth. There's a lot of people out there with that rhetoric, and I think it's only putting fear into something that you're not backing up with numbers. I get that properties and values are going through a correction, right? Because we saw such a crazy increase and a skyrocket during the pandemic. But make no mistake about it, we are not going through a crash. Let's rehearse what the crash was. In 2008 to 2010, we had a market crash. During that time, foreclosures, that 3-year span, we had 4.5 million foreclosures. In the past 2 years, we've had 350,000. Yep, you heard that right. 350,000. And in Q1 of this year, we had 95,000, call it 90, call it 100,000. If we match that for the rest of the year, that would bring the total to about 750,000. We'd be off by 3 million foreclosures from the crash. You heard it here first. The housing industry is not going to go through a crash. It's never going to happen. Stop listening to all the rhetoric. It's not going to happen. That's number one. The second thing that's preventing it is subprime mortgages. Look, I remember back in the day that I had lenders walking into my office that would say somebody with a 580 FICO could do a stated income, stated asset loan, and they weren't even paying their car note. We also had those option arms where people had the ability for a couple of years to just pay interest only. So then as the market was going through a correction, they got comfortable with this interest only payment. Then, you know, all of a sudden the metrics changed. Their payment went from say 2,000 to 4,000. They couldn't afford it. The house started to go underwater because you were only paying interest only. All that principal was being added. It was a disaster before it even happened, right? So that's number two. Those subprime lending mechanisms do not exist today. You don't get the option period, and you cannot go stated down to 580 any longer. Does not happen. And if those programs do exist, you are putting down 20, 25%. It isn't like you can put down 5. It isn't like you can put down 0. Doesn't happen. The other thing is right now, there's only 2% of the U.S. population, given the rampant increase that we had during the pandemic of home values, that are underwater. 2%. I mean, that's nothing. People are not going to walk away from equity. They are going to do everything possible to stay in that home, to make that payment so they can realize that equity position. So we are not experiencing a housing crash. So stop listening to that. You should be focused on, when are we going to see the correction? Are we at a bottom for a market correction? There's no crash. All right. And lastly, I want to talk about don't believe the hype. As I alluded to in the onset, I had a real estate agent call me over the weekend. And the question was, do I offer a free refinance if somebody were to purchase through me? And I'm here to tell you, first and foremost, there is no such thing as free, especially as it pertains to real estate and as it pertains to banking. Not at all. It is all a gimmick. It is all a scam. And don't listen to any lender that is actually pushing that out as an advertisement, because I'm going to tell you two things. Number one, the only way that you can cover closing costs, there's two things you can do for a client. Number one is you can increase their principal balance. I see it done a lot. I see it done to a lot of clients that really don't know what's happening. They're not necessarily savvy. They're so focused on a payment that by increasing that principal balance, paying the closing costs, paying me as the loan officer, they don't even realize it. They don't even care. Even though they may see it, all they see is that payment. That's their focus. That's number one. But that's not free. You're increasing the principal balance. You're taking equity out of somebody's home in order to pay. The second thing is understanding how we get paid, and that's by a yield spread. Much like you in the real estate industry get paid on a commission, we get paid in yield spread. And what that means is it can move anywhere from negatives all the way to positives. And you'll see it in the rate sheet that I share on a weekly basis. The only other way to cover is to make enough yield spread to cover your closing costs. So if today's rate was 6.25 where I made no money, that should be the rate for a free refinance. A free refinance should mean that I'm paying the title fees, I'm paying for the appraisal, I'm paying for the credit report, I'm paying for a survey if it's needed, I'm paying for the appraisal. And there's nobody in our industry that's going to do that. Free does not exist. You are then paying for it with an increase in your interest rate. Your client is paying for it by me taking the 6.25 and increasing it to where I need to cover that yield spread, to cover those costs with yield spread, so that I can tell you it's free. But it's not free. Free would be a zero, and that's not the case. So do yourselves a favor. Don't fall for those gimmicks. The best thing you can do is to lock arms. I'll give a plug for myself with somebody like myself that shares rate sheets, that is a full disclosure, that tells you exactly how much I'm going to make and exactly how much yield is being left on the table or what's at your disposal to reduce costs out of your pocket. You want somebody that gives true transparency and walks you through different options so that you understand them, and realizing that nothing is free. So that's the best advice I could give. It's just frustrating when you see it out there because, any real estate agent, I have seasoned ones, I have new ones. You want to do what's right for your client. Or if you're selling a house, you want to say, oh, free, that could be great. A potential buyer might buy my house because they can get something free. But at the end of the day, it's not free. Nothing is free. It's going to come out of your client's pocket. And in the end, you're going to look like a poor advocate by not putting them in the right position or putting them in contact with somebody that's going to be transparent. All right, everybody, have a great week. Probably talked a little bit long, but I love to talk, as you know. You need anything, you give me a call. I'm around working all week. Would love to help you. Love to help your client answer any questions you may have. Happy selling out there. Have a great week, and I'll talk to you all soon. Cheers.